Hey guys, Indy here, and welcome back to our channel. And make sure you subscribe and smash the like button. And today we'll be going over why is it getting harder to find a new job, what the job market charts are indicating, and is a soft landing without a recession is possible. Let's get to it, guys. This is a pretty cool article from the Wall Street Journal. As you can see, the title is "Where the Job Market is Heading in 2024," and it's pretty much the 6 charts in here we're gonna go over. And let's go ahead here and scroll down and see employers slowed hiring and handed out smaller raises in the recent month. Signs of fading momentum in the job market have some forecasters expecting unemployment to rise in 2024. And also, guys, that might be okay, but the key for American workers and Federal Reserve policy makers is to have the labor market cool without collapsing the economy. That would support household income while helping inflation drift lower, putting the economy in a glide path to soft landing as long as the slowdown isn't too severe. So pretty much what's going on is the Federal Reserve raised interest rate in an effort to cool down inflation because inflation was too high, getting out of control. And also that also slows down the job market. The less double, 2, 3 jobs that people have, they buy less. If people are getting unemployed and people don't have as much money, they will stop the spending. So that's pretty much the goal for the Federal Reserve is to raise unemployment to slightly higher. But sometimes it can get out of control. But their main goal is to slow down the job market because the job market was extremely hot. Now it's cooling down pretty rapidly. And pretty much just a lot of small cracks in there. As you can see, this analyst here predicted from Wells Fargo. And here are the predictions from different banks of what the unemployment might be by the end of 2024. As you can see, Wells Fargo is predicting that 4.5%. S&P Global is predicting about 4.1%, and the Morgan Stanley is predicting 4%. And I think at the moment we're at 3.9% or 3.7. Okay, that's Q4. Okay, but right now we're at 3.9%. So they're predicting unemployment rate to tick a little higher. And some experts said if this goes up by 1%, let's say from 3.9 or from 4 to 5, it usually gets out of control. And by that time, there's nothing the Federal Reserve can do anymore. It's a spiral control, and you can't stop it. You just gotta let the dust settle at that point. And if we scroll down a little bit, so pretty much at the moment we're in a cooling trend. The U.S. Labor market was a pillar of the economic strength in 2023, with a solid hiring and rising wages helping households navigate the higher inflation, which is severely high at the moment. People trying to make ends meet. It's going to be difficult. So several factors combine to cool it off to the point where economists expect hiring to slow considerably in 2024. And here's an actual chart here about the U.S. non-farm payroll change from prior quarter, as you can see here. So it's kind of slow down a little bit and to slow down a lot more. As you can see here, the Fed campaign of interest rate hike made it more expensive to borrow money and also slowing some economic activity. So pretty much companies can't borrow at a lower rate anymore. Now they have to pay 7%, 8%, 9%, which is actually impacting their bottom line. If you think about companies borrow 600, 500 to $1 billion. So this is really affecting companies. So they're laying off more people to save costs elsewhere and being more cautious around the economy just in case if a recession happened, they can have money on the sideline to keep going, to keep pushing forward and save the company. And it's a lot difficult. It's a lot less opening right now. As you can see, by the end of 2023, workers had stopped job hopping as much while, they hired less and kept layoffs low. So the hiring and the separation is, have ticked down a little bit. Pretty same actual little gap here. But yeah, so it slowed down a little bit. If we keep going down, here, as you can see, the less dynamic labor market helped put a break into the rapid growth rate. Consideration for the Fed, the average hourly earnings across the private rose to almost 6% annually pace, but cool to 4% at the end of 2023. So pretty much everything is slowing down. The average hourly earnings from the year earlier is also slowing down as well. Pretty much heavily in the leisure and hospitality sector, and also private worker sector right here. As you can see here, we think unemployment growth remain positive, but too slow to absorb all the instruments in the labor force. Various said that would push the unemployment rate to 4.1% according to SB forecast, up from 3.9% in November. It's the highest level since the end of 2021. So definitely they're predicting interest, not interest rate, but unemployment rate to go up. And see, there's a temporary weakness. Another warning sign for the labor market is temporary hiring, which has been on a downward slope for more than a year. Temps are considered the bellwether for the labor market, where they're often the first hired as a business starting to ramp up, and also the first to be dismissed. So this is pretty much showing the indicator of what's going on. It's a clear trend towards cooling. So we expect elevated layoff into the first quarter to level off or get worse. So pretty much the next 3 months of this year, well, the next 3 months coming up, January, February, March, first quarter, they're predicting a lot of layoffs. So a lot of big companies also are laying off as well. So it's not looking too good. So that's why, for the people that are in the job market, for people looking for a different job, it's a lot more difficult for them to switch. So it's best to keep your current job at the moment. So the labor market is cooling down, which I think will go on and affect the housing market, which I think will go ahead and affect the stock market. So the less money people have, the less they buy, the less they continue to keep pushing forward. So that's going to affect a lot of things, guys, because I myself believe that the job market correlates with the housing market. So that will slow everything down. Although there's not a lot of sales right now, but once people start losing their job, people start getting foreclosures, there's going to be a lot of homes for sale at that moment. So it is not always hot. The market's not always hot where it's really difficult to get a home. So we'll see how that plays out. I also have another article to review with you guys. As you can see, employers finished 2023 with far fewer open positions than the start of the year. So the total job at the end of the year 2023 declined more than 15% from a year earlier, according to data from job listing site Indeed through December 29. As you can see here, we're just scrolling down. Much of the strength in the hiring of 2023 was for in-person positions, such as nursing, childcare, food services, bars, and Indeed data shows. This is a pretty good, interesting chart here, guys, that you can see from February 2022, where it was literally at 70%. The job posting on Indeed year over year, guys. This is a very steep decline, guys. So the posting are pretty much in the negative range. So this is really horrible right now. No one is really posting. There's really no opening jobs right now. So people are being more conservative and they're hiring less. Or people are keeping their job and no one is actually switching or flipping or trying to find another one because it's extremely difficult out there to find something else. And definitely some sectors are hurt more than others. Demand for workers slowed sharply. Human resources posting fell nearly about a third in 2023. So people in human resources are having a tough time finding a job. Job seekers in marketing as well face tougher. As you can see, posting 20% lower than their pre-pandemic level. Persistent demand in in-person workers have led to faster wage gain at the lower end of the pay scale, but a slower economy and belt tightening from consumer could put a damper into those gains this year. As you can see this chart here, guys, child care, right? People are going in the office a lot more, so child care went up. Banking and finance, definitely in the negative. Prepping and food services, 20%. Human resources, definitely in the negative. Marketing, extremely in the negative here. Well, negative 20%, as you can see, the 20 was negative 19. Software development, negative 25%. So some sectors are hurt more than others. And if there is a downturn in 2024, the sectors will likely decline. Okay, retail, food and services, and hospitality are the discretionary spending. So this section right here would be hurt the most once a downturn is here, which is kind of being predicted for 2024. Who knows? Might be 2025. So definitely there's a major slowdown. Some high-profile companies have announced cuts. Recently, as you can see, Exxon said Wednesday that they were looking to cut workforce by 15%. 15% is extremely high for a big company like that. So that's a little concerning. But definitely, this is the fastest way an employer can save costs is let their employees go. So it's not looking too good for the overall economy. And what it's going to do is it's going to roll over to the housing market, and people are going to start losing their home. People are going to start defaulting on their credit cards, defaulting on their car notes. So this is going to be a spiral control, and inflation is still high. Just because inflation is going down doesn't mean the price reverts back down. So we need deflation in a sense to help out, but prices are still high and people are predicting to be losing their jobs. So this could definitely hurt the economy a little bit. Let's just say the Federal Reserve know what they're doing and they could do this without hurting the economy, which I doubt that they can. But all we could do is pray and have our fingers crossed at the moment. And that's it for today, folks. Don't forget to like and share and subscribe to the channel for more updates on economic trends and much more. Thank you for tuning in and see you next time.